Speaker. The presentation will be followed by a brief Q&A. Everyone will remain muted, so if you have a question for Trevin, please enter it into the chat function, and after the presentation, we will get to as many as we can. Trevin Stratton is the Chief Economist and Senior Vice President of Policy at the Canadian Chamber of Commerce. In this capacity, he helps develop national policy positions aimed at improving Canada's economic performance and the competitiveness of Canadian business. An award-winning business economist, Trevin was named as a member of Ottawa's 40 Under 40 for founding and leading BDO Canada's National Economic Development Consulting line. Trevin started at Carleton University in Ottawa, as well as at the London School of Economics in the United Kingdom and the Graduate Institute of International and Development Studies in Switzerland. He has held appointments as an international scholar at Yale University's Jackson Institute for Global Affairs, as an E.C. Harwood Fellow at the American Institute for Economic Research, and as a lecturer in politics, economics, and international studies at the American University in Dubai. It's my great pleasure to introduce Trevin. Trevin, take it away.
Great. Well, thanks a lot, Joe. And if you'll just give me a second, I'll share my screen. There we go. So thanks a lot. It's always a pleasure to be invited to Peterborough's AGM, this time virtually, to provide an economic update. It always reminds us at the Canadian Chamber of the great work that's being done at the local level to support Canadian businesses. And there's no more important time than now to be able to do that, obviously, during the pandemic. What I was asked to do is to give a bit of an economic outlook on the Canadian economy as it currently stands and where we're going post-COVID. And so what I decided to do is I've kind of broken it down into what's happening in the world, because obviously there are some changes taking place when it comes to the global economy, and in particular some changes that are going to be very relevant for Canada, and then specifically zeroing in on Canada as we go along. And there are actually some new numbers that just came out this morning from Statistics Canada, our new GDP numbers, the latest ones that I can go through as well. And so with that, why don't we get started? So first of all, when we're looking at the global economy, for quite a few years now, some people would say it started in 2008, some people would say it started in 2016, but there's been a trend or a reversal of a trend of global economic connections that we've seen kind of reversing in on itself. Global trade barriers have been erected and global trade has not been growing at the same pace as it used to. Global capital flows and global financial flows have not been growing at the same rate as they used to as well. Obviously, when it comes to labor mobility, there have been some restrictions put in place as well. And what we've seen during the pandemic is that this trend has been accelerated in a few ways. Obviously, with borders being closed, obviously with travel not necessarily being as prevalent as it used to be, and certainly with the disruption to supply chains as well. And so really kind of just demonstrating some data that actually goes to show how this has been accelerated. So here we have global delivery times of a PMI, and you'll certainly see that there has been a slowing or slower deliveries and a stronger rate of deterioration for many countries, including Canada. Some doing better than others, certainly. But that global supply chains has certainly been disrupted for most advanced industrialized economies during the pandemic. And obviously this is going to have an impact on global economic connectiveness, but also on exporters, on our opportunities when it comes to trade as well, and also the efficiencies that may have previously been gained from having global supply chains might be shifting now too. Now, the story isn't necessarily the same across all sectors when it comes to what's happening globally in the economy. So there's actually a difference between the goods trade and the services trade that we're seeing. So as you can see from the top left-hand graph, the global goods trade took a huge hit, as the services trade did, as the entire economy did right at the beginning of the pandemic. But the goods trade has actually recovered. Notwithstanding what was happening in Suez over the past week, the goods trade has actually, generally recovered to its pre-pandemic level. And a lot of companies have been able to adapt during the pandemic because of that. Where we're actually seeing the biggest hit is in the global services trade. So there's been, took an even larger hit at the beginning of the pandemic, and there's been a little bit of a rebound, but it's not anywhere near its pre-pandemic level yet. And of course, that has to do with transportation, with tourism, a number of different areas where that just haven't been able to recover because they almost rely on physical presence for their business models to work. Certainly, you'll see that in the top right-hand graph as well. Looking at manufacturing and services in particular, and we see manufacturing obviously being part of the goods sector. Took a bit of a lesser hit and has recovered close to its pre-pandemic level, while services itself has not. And a big story of that is tourism. So you'll see from the bottom left-hand graph. That it took a precipitous drop. I'm sure that's not a surprise to anyone in this virtual room, but hasn't even really started to recover. In the United States, with our vaccination rates, we've started to see a little bit of domestic travel start to pick up again. But we're really looking at the long haul for some of those industries in the service sector. And what is a really interesting story, if you look at the bottom right-hand graph, is that this is actually a reversal of what had been taking place over the past decade. So actually the growth rates in international trade took place much more in the services sector than in the goods producing sector prior to the pandemic. And now we see actually the goods producing sector rebounding much more quickly. So this is a bit of a reversal of the global trade patterns that we've seen, pre-pandemic for the past decade. Here we have international air travel, and obviously travel restrictions have grounded most international air travel. And it's somewhat stabilized since the summer, but just remains precipitously low compared to pre-pandemic levels. And obviously, this is something we're experiencing in Canada as well, and I'll get to that when I zero in on the Canadian section. But of course, this is having a big impact on the transportation sector itself, but also other spin-off sectors of the economy as well. Certainly, business travel is less so, and so it's having an impact on all different sectors too. And this speaks to the point that it's not only trade and services, it's also just international mobility in general that has been impacted, which has had an impact on global economic activity. Certainly, when we're looking at global trade, we see the good trade was hit hardest during the shutdowns, but rebounded quickly. Services trade has been hit a bit harder, but as we're kind of looking forward, as opposed to what just happened, looking into this year, we're seeing WTO forecasts about a trade drop last year, followed by a bit of a rise. So as countries, particularly advanced industrialized economies, start to recover and start to get the pandemic under control, we're looking at this rebounding, but still not completely making up for the losses just yet. And similarly, instead of just looking behind, looking ahead at the global economy, we're seeing significant growth rates projected for this year, and these are numbers from the International Monetary Fund, which came out about a month ago. But even since then, over the past month, the growth rate or the growth projections might be even higher, particularly for Canada, but for some countries too, depending on their vaccine rollout this year. But you'll see robust growth in Asia in particular, really driving global growth. Places like China and India really projected to lead growth this year. But certainly, the growth rates in advanced industrialized economies, Canada, the US, many European countries are nothing to sneeze at either. I mean, even if it is 4.4% growth that we're going to see in Canada, these are growth rates that we have not seen for many, many years within this country too. Though, once again, it won't completely make up for the drop in that we lost in our economy last year. And just to make a point as well, obviously there were relatively large losses in Canada and everywhere during the pandemic. If we're talking about North America, Europe, Australia, advanced industrialized economies, OECD countries, Canada was about middle of the road in the economic hit that it took. Countries like France, Spain, Italy took larger hits, particularly because they're large tourism sectors there, at least compared to ours. But looking ahead, those are also countries that might have a larger rebound because, this isn't an economic downturn like other ones that we're used to. This is one that's really due to a pandemic. And so once that is released, there's going to be a lot of room for growth or a lot of pent up demand for those sectors that have been hardest hit and might be able to rebound very quickly. I will make the note that this is looking forward, but last year in 2020, China was really the only large economy that actually grew last year. Most other economies contracted. And so certainly they're a bit of ahead of the curve when it comes to economic recovery. Apart from this year, looking ahead to next year too, we're still projecting relatively robust economic growth going forward for at least a couple years. So the rebound, the economic recovery will not just be a blip and then go back to normal. But all of that being said, a lot of these countries still won't achieve full recovery. Their economies won't be back to pre-pandemic levels by the end of this year. It will take until at least the middle of next year to get there. So specifically looking at Canada's situation within the global environment, much like what we saw, Canadian goods trade rebounded quickly with what economists like me call a V-shaped recovery. In particular, the restarting of auto plants, while the services sector, travel, transportation, have what economists like me call an L-shaped recovery, where it really hasn't rebounded to significant levels. Now, what's interesting, so this is at the beginning of the pandemic back in March, the Canadian Chamber of Commerce partnered with Statistics Canada to create the Canadian Survey on Business Conditions with the realization that decision makers, policymakers, business leaders really needed data that was not a few months old, that it was such a fast moving fluid situation that we needed to know what businesses were experiencing on a much more regular basis. And so we created this tool. It was a survey, around 13,000 businesses respond. We've already done 4 waves. There's a 5th wave coming out about what businesses are actually experiencing during the pandemic. So this is from the latest wave, which just came out maybe 2 weeks ago. And so businesses, when it comes to the global economy, are concerned with future supply chain challenges within Canada. And many of them are planning to diversify their domestic and international supply chains. And so businesses in some industries in particular are anticipating supply chain challenges in the coming month, the largest being wholesale trade, but also manufacturing, construction, retail trade that tend to be above the average, which is that gray line in the middle. And what's interesting is if we look at the graph on the right, that a lot of them, in terms of diversifying their supply chains, are looking to source them domestically within Canada, not only also diversifying outside of Canada, but definitely a bit of a pull towards domestic supply chains in certain industries in particular, when it comes to securing those supply chains. And so if we go back to those big trends that I was talking about at the beginning of this section, the reversal of global trade patterns and global capital flows, I think what's going to be a big question for Canada and all countries looking ahead is what does this reversal mean? Because, I mean, does that mean that global economic connections, global supply chains are reversing in on themselves to become a bit more national? Not necessarily. There's also a question as to, instead of global, they'll be regional, North American, for instance, or Asian supply chains, or European supply chains, as opposed to just one country. And also, will they apply equally to all sectors? So, maybe we'll see a more domestic supply chains or pushes towards that in manufacturing or in agriculture for food security. Will that apply to other sectors, like the digital economy as well, is still a question that's out there and a variable that we're not yet sure of. So really zeroing in on Canada in particular. So this is hot off the press. This data just came out about 3 hours ago. So this is Canada's latest GDP numbers from January, and even in the midst of lockdowns in many parts of the country, or restrictions put in place in many parts of the country, that with us in Ontario obviously started on Boxing Day. Looking at the economic growth rates, we actually saw 0.7% growth in January for the Canadian economy as a whole. And so that was actually higher than previous projections. People were kind of anticipating 0.5% growth rate this morning before these numbers came out. And that's building on growth in December as well. And so it's very, very interesting to see these kind of levels of growth taking place. Initially, many people thought that the first quarter of this year, Canada would actually see an economic contraction, including the Bank of Canada thought that we would see an economic contraction in the first quarter of this year. Obviously, these numbers are still early. It's from January, but that does not necessarily seem to be bearing out in the data. And this is a very interesting question going forward. I'll get to perhaps the implications of this later on in this section, focusing on Canada. Of course, that being said, the impact isn't being felt equally across sectors. Certainly, there are some sectors that, this is what many of us call a K-shaped recovery, and that there are some sectors that have been able to adapt, that have grown or either at or sometimes even in some cases above their pre-pandemic levels of economic activity. And then some sectors that have really been, bearing the brunt of the economic impact, both in terms of business closures, in terms of economic activity, in terms of jobs, than others. And really the difference maker are those businesses that rely on physical presence for their business models to work, accommodation, food services, arts and entertainment and recreation, retail to a certain extent, though some retail businesses have been able to use e-commerce to transform during the pandemic as well. Obviously transportation too, considering what's going on with travel and tourism as well, that they're really bearing the brunt of the losses and have not been able to recover at the same level, have not been able to adapt at the same level because they can't necessarily use technology in the same ways as some of the other sectors have. And then, with cycles between economies opening up and potentially closing again with restrictions, these are also the businesses that are facing the most uncertainty as well. Here we have kind of similar data, but presented in a different way. So here we have a number of different sectors and the extent to which they have recovered from kind of their initial low to getting back to normal. So you'll see agriculture, for instance, is probably the best performing sector in many ways. It's actually grown during the pandemic and is above its pre-pandemic level of economic activity. Obviously there's an increased demand for agricultural products and food products during the pandemic as well. Certainly looking at finance and insurance, real estate, that might not rely on physical presence. They've been able to recover to a certain extent. While if we're looking at arts and entertainment, it's about half of its recovery has taken place. And that's obviously a huge factor, similar with accommodation and food services. With a potential looming third wave here in Ontario, a lot of these businesses are really up against it right now as well. And so this once again goes back to the Canadian Survey on Business Conditions that I was mentioning with Statistics Canada. So I will just the graph on the left certainly shows a similar story that I was talking about, the most impacted sectors versus the least impacted sectors. What's really interesting though is that there are some sectors that weren't the hardest hit, but that took a relatively large economic impact at the beginning of the pandemic, but have actually been able to recover quickly. And those would be manufacturing, mining, quarrying, oil and gas extraction, and information and cultural industries. So even though they took, some of the largest hits at the beginning of the pandemic, they've actually recovered quite a bit. And that has to do with a few things. Obviously, mining, there's a big increase in demand, both for many clean tech products that require things from mining. Also, certainly, when it came to what was going on with gold and precious metals last year as well. Oil and gas extraction, obviously, energy prices were extremely low back in March and April, but they've rebounded significantly, and we're looking at them rebounding quite a bit as well going forward. Manufacturing has been able to adapt in a number of different ways, in part because of retooling that took place for PPE and other things. What we've really seen in manufacturing too is a big increase in automation as well during the pandemic. That has helped with their growth too. And certainly information and cultural industries, particularly when it comes to the tech sector, has been able to advance. The story is the same when it comes to jobs, or very similar when it comes to jobs. The sectors where we've seen the most job losses are those hardest hit sectors that I just mentioned, and the sectors that have actually seen some gains since the pandemic begun were some of those sectors that don't rely as much on physical presence. Certainly, we still have a lot of room to make up for going forward when it comes to getting back to our pre-pandemic levels of jobs and making up for all the job losses that we've had. But we have had a relatively significant rebound, and really, a lot of the focus needs to be on employment in those hardest hit sectors, or potentially reskilling and upskilling as well. Now, what's really interesting is that we asked a number of businesses how they plan to invest in developing their workforces. Whether they plan to invest in their current workforce or whether they're planning on hiring new skill sets. And what we found is that the majority of businesses do not expect to increase the size of their workforce in the next few months, but they are kind of 2 times as likely to develop skill sets of their current workforce than hire new staff or contractors. And so this really speaks to that kind of reskilling, upskilling, training component within organizations going forward. And that might be how they're planning on meeting new skills needs and maybe addressing skills gaps that might exist within their organization. And also the businesses that plan to permanently adopt remote work are also more likely to look beyond their immediate geography for talent. And so that really has to do with that divide that I was talking about, when it comes to businesses that operate with intangible assets like finance and insurance, like professional, scientific, and technical services, that certainly they are more able to provide remote working opportunities for their staff. But they're also more likely to be able to, look beyond their immediate geography, their own city, town, province, sometimes country in some cases too, to be able to find new talent as well, because they do have that remote working opportunity. And this might be a larger scale trend that we'll see for Canada going forward, and also a potential divide between different sectors on the workforce going forward as well. And so when we're talking about Canada's kind of economic outlook for this year, I mean, accounts vary. I would say most economists are saying we'll see somewhere between kind of 4.4 to 5.8% growth this year, which is incredibly significant. A Conference Board of Canada report came out yesterday really saying, I think it was 5.8%, which is, higher growth levels than were initially projected or that have been projected over the past few months. And part of that certainly has to do with some of the growth that I was just talking about that we just saw this morning in January. What's I think is an important story to keep in mind is what are the drivers of growth, right? There are different things that contribute to growth: consumption, housing, business investment, government spending, exports, imports. And so what the factors that are most going to contribute to growth this year that are projected to are consumption. So a lot of people are saying, there's a lot of pent up demand in the economy. People are waiting to feel safe to spend their money on consuming again. And there's also quite a bit of savings that has gone into bank accounts during the pandemic as well. And so that's really supposed to be a driver for economic activity. Whenever people feel safe to do so, perhaps that will require herd immunity from the vaccine and in Canada when it relates to the pandemic. Secondly, obviously, quite a bit of government spending has already taken place and will be anticipated once again in a federal budget in a few weeks. And so that's going to be a significant contributor to growth. And obviously, I'm sure many of you have heard about what's taking place in the housing industry right now when it comes to real estate prices as well. And so that's a significant contributor to growth. What is concerning about that, and I'm sure it's concerning for Chambers, is business investment. It's not supposed to be a significant driver for growth this year. It will rebound a little bit, obviously, but really we're not looking until 2023 for for business investment to really completely rebound and be a significant contributor to growth in Canada going forward. And obviously, we can't just rely on consumption, housing, and government spending to produce the long-term economic growth that we need. And so this is going to be a very important factor to have the right policies in place that encourage investment going forward to create economic jobs and to create jobs, to create economic growth and to create jobs that will exist over the longer term as well, as opposed to just an immediate stimulus. Certainly, and I mentioned this a little bit before when it comes to the resource sector, but this has to do with the investment story too. So definitely energy prices and therefore the size of the energy industry has already started to rebound and will continue to do so. In Canada, the energy sector has contributed a much larger proportion of business investment in this country than the sector actually accounts for in terms of the size of our economy. But going forward, what we're actually seeing is that non-energy sector investments will probably rebound a bit faster, or at least there's a reversal in that trend in terms of where investment takes place in this country. And so that's a very, very interesting kind of long-term trend. It's something that's changing in the economy nationally as well. Here we have it broken down by province. And what's obviously Atlantic Canada with their Atlantic bubble took a bit less of a hit last year, and they were the best performing provinces in general, and also not only economically when it comes to COVID case numbers as well, of course, because of that bubble that was put in place. What's an interesting story here is that the provinces that took the biggest hits last year are also the provinces that are projected to have the biggest rebounds this year. And that's because what I was mentioning earlier is that this is a unique type of economic downturn where a lot of the economic hit last year was because of the pandemic itself. So as the pandemic subsides over the course of this year, we can also expect those economies that suffered the most from it to also be the ones that will gain the most from the pandemic being resolved. And so this is from the Canadian Survey on Business Conditions too. And I'm sure many of you have probably heard about, that one of the trends during the pandemic has been the acceleration of the digitization of the economy, which existed, of course, before the pandemic, but it's just been accelerated during it. I think that it's very important to unpack that. And because obviously the digital economy means many different things to many different peoples, and there are a lot of different aspects to it. So what we've seen is that certainly when it comes to technology, remote working through technologies, we've seen sustained investment in that throughout the business community, and that will probably be a bit more of a longer term trend. Many businesses have adopted cloud solutions, collaboration tools, security software tools to enable remote working. And we see that, being the highest in some of those service sectors, finance and insurance, information and cultural industries, professional, scientific, and technical services that once again don't rely on physical presence. So they're focusing on investing in those areas and potentially promoting remote work or having much more remote work within their organizations going forward. But what's really interesting to me is that if we look at investments, not related to workforce, investments related to productivity, artificial intelligence, machine learning, automation, non-remote working technologies, that they've actually lagged. There's about the proportion of businesses that have adopted or incorporated artificial intelligence during the pandemic is 2%. Same for machine learning, right? And so that's probably not nearly at the levels that a lot of people talking about the digitization of the economy would imagine. Automation is certainly higher, particularly for some sectors, as I mentioned, for manufacturing in particular. And the majority of businesses, also when we're looking forward, they might not be investing in, for instance, renewable energy or energy efficiency measures to the same level as we would expect as well. And I think what the broader story here is that business investment story as a whole that I was talking about previously. Business investment is projected to remain relatively low, and of course that has to do with things like investments in technologies and investments in other areas as well. And that's why it's going to be so important for governments to put in place those policies that encourage business investments for things like digitalization, but just for business growth and job creation in general as well. And then finally, I wanted to, I kind of started with the more shorter term aspects and looking backwards, and now looking over the very long term going forwards. Obviously, when it comes to the fiscal situation of Canada, our governments, our businesses, our households, there's going to be a long term impact when it comes to this. So this is the change in debt to GDP that happened in Canada. So it's increased by nearly 80% last year. This is the largest increase from many countries in the world in terms of debt to GDP. Of course, that's not necessarily taking into account our initial debt to GDP position, which was better than many of our G7 peers. But there's been a lot of spending that took place, and I'm sure that's not a shock to anyone here. Much of it necessary. Certainly don't get me wrong. A lot of this was definitely necessary. I think one of the questions for a lot of economists out there is that was the full amount necessary? So for instance, in the second quarter of last year, the amount of money that went out was about $30 billion more than the amount of money that was lost in salaries and wages. And that might be one of the reasons, amongst many other reasons, why we're seeing quite a bit of savings in bank accounts as well. Of course, people just not necessarily having things to spend on and just being risk averse in terms of spending as well in the middle of a very large economic downturn, being significant factors too. But obviously, this is going to be something that all of our governments are going to have to grapple with going forward. And just as one note, I'm sure you'll see that you might be wondering, why are savings going up and household debt is also going up at the same time? That might not make sense. Well, a lot of the money that's gone into the economy has obviously gone into the housing sector, and that increases household debt too. And so that's that helps explain it. And so, particularly considering the numbers that came out this morning with higher growth than was expected, I think a lot of economists are starting to take into account what we call the upside risks. The fact that our economy might be growing faster also creates risks in terms of overheating the economy, in terms of creating inflation. If there is significant inflation, then what happens to interest rates? And if interest rates do start going up, then what happens to all this debt that we racked up? And so there are a lot of moving parts there. I'm not necessarily saying that all of that will take place, but definitely starting to be serious considerations amongst policymakers and economists. And so with that, I'll leave it at that and maybe open it up to some questions if we have time. We do.